Mutual funds, index funds, and ETFs, that is what we are talking about today. Now, if you've ever considered investing in the stock market, then more than likely you have heard of these terms before, and you're probably trying to consider which one is best for you. So that's what we're talking about today. What are each one of these things? What are the advantages, the disadvantages to each one of them? And then I'm going to share what I think is going to give you the highest rate of return, your best ability to maximize your investment so you can build the most wealth for yourself over time. So let's just jump right into it. Hey, what is up, everybody? My name is Sean, and if you are into personal finance, increasing your income, and building wealth for yourself, then this channel is probably for you. So after this video, make sure you check out my other videos. I'll put some links down below to some of my most popular ones. In addition, before we get started, I want to address the elephant in the room right now, and that is the like button. So let's just go ahead and just obliterate it. Just smash the like button right now, just so we can just get it out of the way. Anytime you comment, like a video, subscribe, it sends a signal to the YouTube algorithm that this video is good, that other people may want to watch it or has vital information, and it basically will help push my video out to more people. So I would greatly appreciate it. So now that we have that out of the way, let's jump into this. Okay, so the very first one I want to talk about is mutual funds, and that's also because it's the absolute oldest of the three. Now, believe it or not, mutual funds actually date all the way back to the 1800s. And the idea at the time was if we took a group of people and they put all their money into like a pool or a pot, they could use that money to make an investment and help grow their investment over time. Now, without going into too much detail, a mutual fund differs from a stock, where a mutual fund is simply a group of stocks. So instead of going out onto the market and buying individual stocks at a time, what you can do is invest in a mutual fund, which typically has a minimum of around 90 to 100 stocks, and sometimes even more than that, and invest in one fund that comprises all of those stocks together. Now, mutual funds have become very popular over the years, especially with finance gurus like Dave Ramsey, who's always stating to just put your money into a mutual fund and let it grow over time to build wealth for yourself. So let's talk about some of the advantages of mutual funds. One of the biggest advantages is simply diversification. And for those of you who don't know what diversification is, it's when your money is spread out over multiple companies instead of one. And the biggest advantage to doing this is it helps prevent you from massive losses at a time. So if you were to take your money and invest in one single stock, and that stock happens to not do very well and it takes a bit of a fall, well, all your money is falling with it. Whereas if you invest in a mutual fund where your money is spread out over, let's say, the 90 to 100 different companies, if a few companies aren't performing as well as they should be, and they go down, well, guess what? Your money is not going to deplete as fast as it would because you have all the other stocks that are hopefully doing well or maybe even performing better than expected. The second advantage to mutual funds is that they are professionally managed. So obviously one of the biggest challenges with the average person who is investing is that you probably don't have a lot of time to spend researching companies and analyzing their P&Ls and their assets and the liabilities and how much money they're bringing in, who's managing the company, what the future outlook is going to be. And that is the job of a professional money manager. Their job is to understand individual companies and understand who has the greatest potential for upside growth. So when you invest in a mutual fund, you actually have a professional manager who is actively buying and selling on your behalf, trying to help you maximize your returns. And the third one is convenience. Investing in mutual funds are very, very convenient and very time effective and time saving, because instead of investing in a ton of different companies and trying to keep up with what company is doing what, how much of your money is where, and how do we kind of reallocate our assets, the thing you can do is just invest in one mutual fund that tracks all of these companies at once and basically manages your portfolio for you. Having to go on the stock market and individually buy 100 different companies will take a ton of time, and it'll also cost you a lot of money and acquisition costs. So every time you make a purchase, usually you're having to pay a transaction fee. And if you're having to pay transaction fees for 100 different companies all the time individually, that can be insanely costly over the course of your investing career. Now, there are some disadvantages to owning mutual funds, and so let's talk about those for a quick second. In my opinion, one of the absolute biggest disadvantages to mutual funds are the cost. So if you remember just a little bit ago, I mentioned that when you own a mutual fund, it is actively managed by a professional. Now, that doesn't come for free. You essentially have to pay for that service. And you will find this payment under the expense ratio of a mutual fund. Every single mutual fund has a different expense ratio, typically ranging from 1 to 3%. And that expense ratio tells you how much of your money is going towards paying someone to help you manage that fund. So let's say that the mutual fund that you are looking at has a 2% expense ratio. What that means is that for every $1,000 that you spend, essentially $2 of that is going to paying the manager. For every $10,000 you spend, then it would be $200. And for every $100,000, it would be $2,000. Now you might be thinking, okay, well 2%, that doesn't really sound that bad, right? It's like, okay, if I spend a $1,000 investment, I only got to pay $2 of it towards the manager. And yes, on the surface, it seems like it's pretty cheap. However, what a lot of people fail to realize is that those fees compound over time as well. Recent economists have determined that for every 1% that you spend in an expense ratio, you could be missing on over 20% in potential profits over a 20 to 30 year investing span. So when you're paying 2 to 3% expense ratios, that could be upwards of a 40 to 60% loss on potential gains. So it does get very expensive over time. So let's move on to the second category, which is index funds. Now, index funds came just a little after mutual funds and was created by a guy named John Bogle, who is also known as Jack. Jack was a money manager and an investment guy who saw how much people were getting ripped off with mutual funds. And so he created a company called Vanguard. And the whole idea behind Vanguard was it was going to be an index and it was going to be a very, very low expense ratio. He wanted to make sure that people's money were staying with them and not paying active managers to manage their funds. An index is really just a fancy term for how well the stock market is doing in general. So when you're investing in an index, you are essentially investing in just an overall kind of benchmark performance of how the stocks are doing overall. So index funds are very, very similar to mutual funds, and that index funds also comprise a group of stocks. The biggest difference, however, is how they are managed. As you remember, with mutual funds, you have an active manager or a professional who is buying and selling on your behalf. When you invest in an index fund, you are investing in a passively managed fund. Now, once again, there are indexes in all different types of categories, but one of the most famous ones that Jack Bogle created was the S&P 500 index through Vanguard, also known as VFIAX. So one of the main advantages to index funds are actually the cost. If you remember, we said mutual funds cost you somewhere between 1 to 3%, most of them being in the 2 to 3% range. Well, with index funds, because they're passively managed, basically through an algorithm that just kind of trades the same way that the stock market is doing, you don't have to pay nearly as much money towards your expense ratio. If we go back to our example of VFIAX that Jack Bogle created, the index fund for the S&P 500, you will see that the average expense ratio is close to 0.04%. So as you can see, there's a big difference between 0.04% and 2 to 3%. This will have a massive difference in your portfolio withholdings over the next 10, 20, 30, maybe even 40 years, depending on how old you are. So this brings me to my third category, which are ETFs, and those stand for exchange traded funds. Now, there tends to be a lot of confusion between index funds and ETFs because they are very, very similar in the way they're set up, and there's only some minor differences to them. So I want to talk about that. So just like index funds, ETFs are passively managed as well. So you're going to have a very, very low expense ratio, just like you do with index funds. So one of the biggest advantages of ETFs is that you're able to trade them 24/7, much like you would on the stock market or individual stocks. So this can be a really great option if you're someone who likes to buy and sell kind of throughout the day. However, this is also kind of a disadvantage because honestly, people who invest in ETFs or people who invest in index funds typically aren't going to be day traders and swing traders where you're trying to, buy low in the morning or something and then, oh, it went up a few percent, let me go ahead and sell. People who invest in ETFs and index funds are typically investing for a long period of time. They're doing a buy and hold strategy. So even though this is an advantage, I also kind of consider this a disadvantage because you have so much more options of buying and selling throughout the day. It sometimes can lead you to making emotional trade decisions based on how the market is fluctuating throughout the day. One of the other advantages of ETFs over index funds are that ETFs tend to be more tax efficient than index funds. One of the other major disadvantages to ETFs is that depending on your broker, is that every time you make a purchase or sell of your ETF, you will have to pay trade commissions, and that really can eat into your profits over the course of your investing career. Now, another disadvantage to ETFs are a thing called a bid-ask spread. This is simply another cost that is associated to ETFs that you're not going to find in index funds. However, it's one of those things that are really, really small and honestly are probably not going to make that much of a difference in your overall investing gains in your career. Okay, so the big question becomes, which one should you invest in order to maximize your returns and have the most profit and build the most wealth for yourself over your investing career? Now, while there's plenty of advantages to each one, and there can be certain scenarios where each one may make more sense, as a general rule of thumb, and usually my piece of advice that I give to people is invest in index funds. If you're not really sure which one you want to do, you cannot go wrong with index funds. The main reason being that when compared to mutual funds, index funds have a much lower expense ratio, which is going to help you capture way more gains over the course of your investing career. And in addition to that, with mutual funds and the active management, most studies show that over the course of 10, 20, 30 years, only a few % of managers can actively beat an index fund consistently over time. So it really kind of rules out some of the advantages anyways of that mutual fund. So index funds are way more cost effective and provide a lot more benefit long-term than mutual funds. Now, when looking at index funds from ETFs, honestly, once again, I think index funds win because the only real advantage of an ETF is your ability to buy and sell throughout the day. However, if you're investing in an ETF or an index fund, more than likely you're a buy and hold investor. And so for most people, except for maybe a few situations, index funds are going to be the one that gives you the most bang for your buck and the most benefit. So once again, to wrap it up, I think that the best option for you is going to be index funds. That's going to give you the highest return and the greatest potential for building wealth for yourself. However, you just never know how the markets are going to do. And there may be some periods where mutual funds outperform certain index funds. But in general, I do believe that index funds give you the best value overall. Now, make sure you leave some comments below. Which one do you invest in currently, or which one are you planning to invest in? I want to hear your thoughts. If you have questions, leave those below as well. And if you have not yet, smash that like button for me. I would greatly appreciate it. Also, hit the subscribe button and the little notification bell as well. It would mean the absolute world to me. Stay safe, stay well, and let's crush it.